Hello, everyone. Welcome to this week's episode of Commission Breath. Brandon Love here with Tom Moffat, and a special guest today. We have the prepayment mentor, Matt Imhoff, here to talk about prepayment penalties, why you should care about them, how to leverage them to close more deals, and a little bit of database mining that you can use these for as well. So thanks for joining us, Matt.
Thank you, Brandon. Thank you, Tom. Thank you for having me today.
No problem. So the reason why we have Matt on today is because I've been seeing your posts all over the Island B Facebook group for quite some time now. And the one that caught my attention was regarding database mining and some really cool opportunities for mortgage brokers regarding prepayment penalties and some really cool opportunities to get business today by mining your database based off of where the penalties are with some of the big banks. So we want to touch on that first of all and then kind of dive into really the nitty gritty details of penalties here in Canada with the big banks and why mortgage brokers should pay attention and educate themselves with it. So, why don't we start off? Like, I'm curious, do you still do brokering or is this your main gig now?
I do the easy brokering. Like if the client does what I tell them to do, then why wouldn't I spend 20, 30 minutes a day in doing that? Like I know where I want to take this when it comes to educating brokers and helping them educate consumers and building tools and like an area that can cost people so much money that we shine a bigger light onto it. I know that's probably going to take me giving my full force and can only really focus on one thing and do it very well. And I love penalties. And I even look at in terms of me when it comes to how I sell myself. I feel so much better selling myself, educating brokers and helping them protect their clients, even more so than I feel confident when I'm selling like myself as a mortgage broker. And I find when you truly believe in the product that you sell, you can sell it. And it's less about us missing out on the opportunity. It's more about the client missing out if they get connected with the wrong person.
Yeah, I can see the passion through some of the posts you have on there. And I could see it just talking to you right now. And we agree because, like, in terms of focusing on one or two things at a time, like us specifically with our business, we've been consolidating a lot of stuff on the mortgage broker side of things to focus on commission breadth and tango. For example, like we shut down our personal YouTube channel just to give more attention to what we have going on here. So I completely understand that.
Yeah, so how long were you brokering before, and were penalties always an obsession of yours, or how did you kind of find this? Because it is a big niche. I find not a lot of people focus on this. So how did you touch on that?
I've been a broker for it'll be 9 years in September, which is crazy. I feel like in BC, because our licenses are every 2 years, you kind of know because when do you renew your license? So obviously it's an odd year, so at least I don't have to pay for my license renewal this year. And so I find with brokering, like there's so much information, and then there's certain things where like this is just the way that it is. I've always been the kind of person like I want to know why. And if someone just says this is the way that it is, it's a poor answer, right? And maybe they're saying that because they're worried about being wrong or they don't understand it, or where they just don't have the resources and the time, or maybe their clients don't really even care if they know it because they've built a big business. And so I look at this, it's like if I'm imagining a new broker is not focused on the mortgage that needs to be returned, even though if someone's doing a transfer, they have to return a mortgage to get a mortgage from you. You'd think you'd want to know the return policy, as well as if you're selling a mortgage, there's no guarantee that they finish the term, get the balance down to zero. Most mortgages, there's some sort of return fee or penalty. And so remember, it's like don't quote penalties, leave it up to the banks. But they have it where you have to call in, their calculators don't really work. They only tell you when your IRD is greater than 3 months interest. They don't tell you when it's less. Then I remember thinking, they're like, okay, we can only quote a penalty for today. But then I was like, what's a payout statement? If you're paying out a mortgage in 2 weeks and you get the payout statement today, it's not a quote for today. It's a quote for 2 weeks from now. It just says you're going to make your mortgage payment on Thursday. Your balance is this. You pay the whole amount. If you don't pay it on this day here, we add on a per diem. Right? And that's what it is. So the more I dug into it, the more I realized it's like, well, why are the bank penalties higher? Is it a fair penalty, like what the lender's actually out, or is it more, or is it less? And just having it where then I built a calculator that mapped out the entire term. And it did like simple calculations. It didn't really factor in like the amortization. We added that, and then the present value of like all these interest rate differences. And so over time, I was getting more and more accurate, and I was seeing different trends where it's like if actual rates dropped faster than the posted rates, you could have where someone closes a higher rate, but maybe if they move quickly, their IRD stays below 3 months interest. And now they jump to a rate that's 0.5% or 0.7% lower, pay 3 months interest. And as long as they're keeping that for the 3 years, 3.5 years, The rest is savings. And anyone who's getting a 5-year fix or is partway through should be planning on keeping it. If they're not, then they should want to know about penalties so they know how to pivot before the IRD goes up, and also so they can have a better idea of what their costs are going to be when they actually do something to their mortgage. So the more I dove in, I presented an MPC, the virtual symposiums during the pandemic. Was invited to present at the national conference in Vancouver in 2022. And then I was just like, when are you doing a course? And I'm like, course, like you have to always update it. So I was trying to think of how to go and do this. And that's where we kind of stumbled across Prepayment Penalty Mentor. Was kind of like, I need to share what I see, try to simplify it, try to break it down. If you get this mortgage, like where's the IRD at? What has to happen for the IRD to be bigger than 3 months interest and be the penalty that's paid, or 10,000 or 15 or 20,000 penalty? And then knowing how the lenders control these levers determine, well, TD Bank, a bank that could just lower their posted rates 1%. All these mortgages have IRDs. It's a First National. They should offer that rate that's 1% lower. That's harder for them to do. What do they need to do? Bonds at the drop, probably close to 1%. So the idea is you can look at these metrics and go and determine, well, more likely for a bigger penalty with TD, but maybe in that case they're offering a lower rate in cash back. We all know what the client pays and what they save if they finish the term. But what happens if they break at different points under a wide range of factors? So it's just diving in and just realizing with this that we're selling products that we don't understand. Clients might think that they return the mortgage and get a lower rate. Clients might think that their penalty is 3 months interest. It's all just about managing expectations. And we need to be less involved with the wins and losses of the clients, but more like, did we do everything we could at the time? And did we pivot if a decision ended up being a bad decision? But over time, how do we make it not be as bad of a decision?
So when it comes to like measuring the penalty, you mentioned the payout statement. So going back to that example, let's say we found an opportunity to save a client money by breaking their mortgage, bringing them into the lower rate today because we're in that unique time where we have that, I think it's 3 months interest. You can correct me if I'm wrong. You get that payout statement, but it's usually earlier than the day of closing. Is there a situation where you're coming up to closing date and for whatever reason that penalty becomes an IRD versus 3 months interest?
So if we're looking at this, so let's say we have a 6% 5-year fix from the bank from the fall. Bonds were high, they locked in. If we look at those mortgages there, right? The only way that the lender, if it's a posted rate and a discount, can increase the penalty, the IRD, is to lower their posted rate. So we've seen actual rates drop closer to 1%. TD Bank, for example, the difference between the 5-year when the mortgage originated and the current 4-year is 0.3%. So the story they're telling that client is we lent you the money at 6%, we can get 5.7%. But meanwhile, people are getting closer to 5%. So even though that IRD, it's below 3 months interest, we want to determine what has to happen for the IRD and 3 months interest to be the same. So maybe it's TDS to lower their 4-year post rate 0.1% more, and then they're the same. But what it also does is it creates what I call our target savings rate. So if they've told us at 5.6%, creates an IRD and 3 months interest at the same. If I were to get a new 4-year fix at 5.6%, take my penalty, lump it into the mortgage, and match my payments, I'd be in the exact same spot after 48 months. Why would you do that? There's no value you're adding. You see, someone needed to do something to like lower their payments. You're not saving as much interest. But at the end of the day, you have to get them a 5.5, a 5.4, a 5.3, a 5.2. Assuming you match the payments and do all this, the new mortgage becomes better 6 months before the scheduled maturity, a year and a half. And so what you look at here is TD Bank is charging a penalty as if they can only get 5.6% when really they're lending money at 5%. So there's 0.6% per year of what I would call a penalty mispricing. And that's what brokers need to go and find and capitalize. Now, TD could go and correct this in a week, 2 weeks, a month, drop all their posted rates. Now the savings target rate's 5%. The actual rates are 5%. There's nothing you can do. But at the end of the day, for a broker, the only way we can confirm that penalty, so there's 2 ways. One, get a payout statement that says your penalty is this until this date, and then you order a new one. Or for the client to go into the branch, pay the penalty, sit in an open, pay a premium at that open rate, get everything done, order the payout, and go and move. And so the idea for this is it doesn't matter what our clients do as long as they're properly informed. Hey, your IRD is less than 3 months interest. We've identified a savings opportunity that will save you about $10,000. Okay, what are we up against? Well, we're up against one, getting an approval with the new lender, and also two is if TD Bank lowers their 4-year posted rate by more than 0.1%, your penalty goes up. They drop it 0.2%. Maybe now I'm only saving you 0.4% per year instead of 0.5%. But we're breaking it down so they can see it, and we're identifying what we can do, whether it's we have a lawyer that can order the payout early. Some brokers have relationships like that, or have the client go to the branch and pay the penalty. So it just really comes down to knowing where we're at. And if someone misses an opportunity, you still let them know, hey, you have a big IRD, we missed the window. They still see value of the support that the broker is providing. It's up to the client to go and take the action based on the expertise of the broker.
Yeah, so you got to have that conversation up front with the client and say, hey, this is a small window of opportunity. There is a chance up until closing that it changes. But
Yeah,
rest assured, we're not going to proceed with something if it doesn't make sense. So this is something that we're monitoring ongoing, and we're going to assure you that we're only going to proceed if it makes sense.
yeah, absolutely.
You got to have like a preferred lawyer, ideally in this situation, is what you're saying. You got to monitor posted rates and make sure you're on top of the payout statement. And then you have to be educated enough to know when TD or any bank is lowering their posted rate, if that's where you're bringing them from.
The thing here is that the lender is banking on either the clients not knowing that their penalty is less than it should be, the broker not feeling confident to know what has to happen. Like there are people that, oh, my 6%, I should have locked it at the peak. They think that they're paying that for the next 48 months, but they have no idea. Part of the training here too is there's going to be brokers that connect with a client. And they're like, I don't know why your penalty is 3 months interest, right? Because nobody's really paying attention to the posted rate, what it was, the discount, the current one. A lot of lenders don't even highlight the posted rate changes on their updated rate sheets. They don't have a history. In Prepayment Penalty Mentor, we have a history of the banks going back. So I can look back and say, hey, if you got it around here, IRD or no IRD. And we can look at it at whatever range of rates and terms and amortizations and mortgage amounts and look at it and go and say, like, for example, like at the time of recording right now, I can't find any penalties with TD for any mortgages where the IRD is greater than 3 months interest. So I would tell the brokers, if you can add value by paying 3 months interest, go.
Yeah.
Then you go and find out if they're like, I'm selling in a year. It's less about saving penalty versus interest and more about limiting that penalty in a year. So just mapping all this stuff out. But if we think about that 6% 5-year fix, and I'm pretty sure this is the case with all the banks, I know it is with TD, Scotia, and HSBC when they were around, is that you close with an IRD of 0. Okay, so your fixed rate mortgage closes because your posted rate and discount are set on closing. So if for some reason between approval and signing with the lawyer, the posted rate changes on the closing date, they'll just either increase the discount if the posted rate goes up or decrease the discount if the posted rate goes down. You have the same contract rate, and then they reconfirm this with you in a nice welcome letter, confirmation letter, and then it's in your annual mortgage statement that shows your posted rate and your discount. They have some examples. So you look at, you close at 0. The only way that the lender can cause your IRD to change, it can go up if they lower the current closest comparable, so the 5-year posted. It can go down if they raise it. That's the only lever that they can use to impact you. Penalties 3 months interest. I like to express 3 months interest as a percentage of balance. If your rate's 6%, 6% a quarter of the year is 3 months. Quarter of 6% is 1.5%. My minimum return fee is 1.5% of balance. Okay. So I'll teach the learner to say 1.5%, 5 years left. And then that's where I can go and determine how much of a difference that we can handle. Because IRD is always calculated. And so you have it here where, well, what causes us to no longer care about the current 5-year when we are compared to the 4-year, which with TD Bank is at 53 months remaining. Do you see the story about the woman with the $30,000 TD penalty? Did you ever hear about that?
No.
I've seen a few of them. Yeah.
So for her, 5-year fix, September, October 2018, 3.71%. Okay. Her 5-year post was 5.59%. Her mortgage closes with an IRD of 0. Penalties 3 months interest. At 53 months remaining, it was baked into her mortgage to say we lent you the money at 3.71%. We can only get 2.01% for the remaining 4 years, 5 months. That was baked in because the 4-year posted was 1.7% lower than the 5-year. Didn't matter what they did with rates. They'd actually have to adjust the posted rates for that to change. So because of that, at 53 months remaining, her penalty spiked to around 42,000, and we were estimating an IRD from 53 months remaining to 5 months remaining. 48 months for tracking. So 4 years of an IRD greater than 3 months interest. What about a 4-year fix? What about 80% of what you want? Hey, the rate's the same, 3.71. Your payment's the same. But with 20% of the penalty risk, we're overvaluing that 5th year and we're taking more risk than we should. What do you think our penalty would have been if she had taken the 4-year fix.
20% less.
Her penalty would have been 3 months interest.
Fail.
Fail. Exactly. But we're pushed to sell 5-year fix. The clients are pushed to ask for 5-year fix. In fact, we used to have it where you could qualify for more with a 5-year fix because you could qualify a contract rate. Pretty sure the banks really liked that, because if that was the product where they positioned a higher posted rate and the gap was between the 5-year and the 4-year, we'll let you buy more than you could afford otherwise, and we'll trap you with this penalty. It's just kind of understanding all this stuff.
Assuming that we understand, assuming that the mortgage broker is completely educated when it comes to penalties, how do you translate this to speaking to a client? Because what you just said, that client is going to be like, what the heck are you talking about? How do you simplify it for them? And how deep do you go when it comes to conversations on penalty? Because, you have those clients and, that person could have been an example. Maybe she just wanted the lowest rate and didn't care about the penalties after you talked to them. So how do you go about navigating that?
So you simplify it to like what it is that they really care about and what they're expecting. So if I got a client and they want a bank 5-year fix, so for there they want the lowest rate. If it's the only way we can qualify, it's like buy the place, penalty risk, or don't buy the place. So in that case, you still warn them of the risk, but it's less choice. So what I'll go and do is I'll go and say, look, I'll sell you a 5-year fix. In fact, you're probably more protected buying a 5-year fix from me than from pretty much any other broker. Okay, because I'm going to identify what this means. Assuming you have the option of other products, you're doing this because you think rates are going to take longer to come down, or you value that low rate cash back and what we're dealing with. So I tell them TD Bank has these posted rates. The day after closing, for TD to charge you more than that minimum penalty, and I break it down to, let's say it's a 5% rate, $12.50 per 100,000. They have to lower their 5-year posted, and let's say by 0.29%. I do the math, I figure it out. If they have a really low amortization, they have to lower it by a bigger amount because the expected interest is lower. So I tell them this, I show them, here's a 5-year post. I'm going to be tracking this. If in 6 months you see your friend getting a 3.99%, are you going to want that rate? I say, yeah. I'm going to tell you now that TD Bank is going to charge you a penalty based on 3.5, 3.2% to go to that, in which you would only do that if you had a ton of debt or like you needed to do something with your mortgage. And I'm going to tell you as your IRD increases, and before you even see a rate you want, I'm going to tell you your penalty is more than it should be. So this is a one-way trip. You win by finishing the term. Those who return the mortgage early subsidize their interest rates for those who don't. If you need to return that mortgage early, you want to do it early in the term or late in the term. More likely to be 3 months interest. Don't expect to get a lower rate. I'll track it as we go along. If I see an opportunity to save you money, we'll try to pivot to it. But if not, I'm like, hey, you've picked this product. The only way we'd pivot now is if there's a good chance you will not make it to the end of the term or close to the end of the term. And their IRD will go up and they're like, oh, I shouldn't have gone with this 5-year fix. But at least they'll be protected. And then they have it where, oh, we need to go and sell. Maybe we do some lump sum payments. Maybe we increase the payment amount, lowering the amortization, lowers the IRD, and just have it where you help to mitigate this. Or maybe there's a point where like the penalty might go up further. You're 3 weeks away from getting that payout. Let's pay the penalty, go into an open, pay $600 extra in interest, then get the payout. Otherwise, if they go and lower this 3-year posted by 0.1%, it costs you $1,000 more or $2,000. We show them the levers that the lenders have, and we dollarize what it means for them. If you need to break your mortgage to drop at 0.2, it costs you $2,000, $3,000, $5,000 more. The only way for us to guarantee this is to pay the penalty and go into an open. That costs you $1,200 more of interest, but as long as this happens or worse, it saves you money. Do you want to buy this insurance? And then a week goes by, post rate change, you just change the offer again and again and again. They don't need to buy it to see the value of it. There's clients that buy it that didn't need it, but also two is, what if a client's a negative IRD and it takes 4 posted rate cuts before their penalty goes up and they're paying the penalty and they're going into an open? That's unnecessary. You do it when it's closer to here, and we track the historical posted rates so I can know, hey, when was the last time TD cut their posted rates or they made a change? What was the range? What was the amount of time between a cut today and a cut next week or next month? And then we go and just be like, oh, IRD's gone up here. Historically, they've waited at least a week before they cut their posted rate again. If they cut another 0.1, it's $1,000. I've calculated it's $300 in interest to pay your penalty now and switch to an open. Your choice. and we leave it up to the client, but we break it down where we're just pinpointing everything. It's like if I lose a client to RBC, I'm like, hey, before you go, ask RBC to tell you what has to happen for your penalty to be more than 3 months interest. And they will not be able to tell them. Because even if they could tell them, they don't want to tell them because they don't want people to see the risk. They want them to see the low rate, the cashback, the Avion points. They want to go for the lowest rate. And as brokers, we don't need to match or beat the rate. We just need to provide more value. And so if I lose that client to RBC, I go and put in my notes their RBC mortgage, the date they closed, what posted rate they closed at. And then as the IRD changes, I send them a quick update and just say, hey, so you know your IRD is 1 month interest. Don't see any savings opportunity. RBC is not equipped to tell you this. But if you have any questions, you need any help, reach out. And I want to have it when they finish that 5 years, they saw that IRD, how it changed. And then maybe when I get an opportunity to win their business in the future, they've added a little bit more value to me. Matt's worth 0.05, Matt's worth 0.1, Matt's worth 0.15. Because there are clients that will not use a broker unless they match or beat the rate. So in that case, they value the broker at zero, nothing. We are worth way more than that, especially those that work hard to improve and be experts. And in the training, we have it where I'm a prepayment penalty mentor to help brokers be prepayment penalty experts.
I like that analogy of you start basically at zero, and as you add value, that's your worth of the discount to the client. And I think it's a great way to look at it. So that when someone comes to, newbie mortgage pros or RLMB and they say, oh, RBC stole my client, yada, 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 you start saying, okay, what was the value you added? Where did you deliver outside of rate? And it's great to kind of look at your own offering and say, where am I adding value to the client? And what is this actually worth? If the shoe's on the other foot and someone's giving you a service, what would you actually value? And knowing penalties is one, knowing the budgets, the rate assurance, different things we do does add certain tiers of value for clients.
I feel like we talk out of both sides of our mouth in this industry. It's like, oh, a broker can get you a really great rate, but there's more to it than the rate. I'm like, well, what is it?
Yeah.
Like, yeah, if you get a client qualified on the A side and it was only B side options, or they offered a really poor renewal rate, or you like refinance and save a bunch of money, then yeah, you saved the money. You were the lowest rate, the best option, and a ton of value. But I find anyone focusing on lowest rate, you have to slash features. Like a budget brokerage would have a hard time tracking all the stuff and having their staff understand the stuff. They would take whatever off their plate that they could, and they'd want that client to be as far along in the process as possible with a safety net in terms of like, if we can't get it done, you have your approval elsewhere. And then have it where the client is willing to sacrifice all the work that the broker did. Penalties aren't important and whatever. We're just focused on the lowest rate. Because if someone is worried about a penalty, they choose a product that's not the lowest rate. If they want someone to track their penalty and help them out, they choose someone who's not the cheapest, branch, super low rates, no hands-on support, reactive versus proactive. And so at the end of the day here, it's up to the client to decide what they want to pay for. And I think for brokers here, like there's ways we can add value, even just a little bit. But also if I need the numbers to work for that mortgage to go through, maybe I'm incentivized to go and say to the client, like, look, if you buy the insurance, it doesn't save you money, I'll cover half of it. Why? Because I'd rather give them $500 now the deal fund than them say, you know what, we think that TD's not going to lower their posted rate, and then it drops, and then now the deal doesn't go through and they're upset. We got to help the clients protect themselves from themselves and just mapping this stuff out. And if it's a good savings opportunity, we want to make sure that they have that option. And then if they miss out, we want to recap how they missed out so that maybe in the future they're more in tune with reading our emails, getting back to us, because we need them to work with us in order to save the money.
What do you recommend brokers do to track posted rates on the files and also where they're at with lenders today? Like obviously you probably have some sort of setup within your training, but if a broker's like, I just want to set up a spreadsheet and monitor my past files, like would you just recommend you just plug in the posted rate at the time of closing and then just monitor today's rates and reference the spreadsheet?
So in this case here, pull up the rate sheets, go through, you can go and recreate it, right? Shows the changes, right? Now, obviously, if you don't know the exact date, you don't know when it changed, you want them to confirm with the lender directly. So whether it's an annual statement or asking the lender what the discount that they received, I look at it, in my opinion, lenders should be providing us with their posted rate history, their rate history. Hey, TD, Scotia, RBC, BMO, CIBC, National, why aren't you telling us?
Yeah, for sure. I mean, I think it'd be very useful in our channel because we only want to support monos. Like we would love to give more business to monos. It's just like right
Yeah.
now with where rates are at, they're just not as competitive as some of the big banks, right?
But it comes down to us not describing the product. If the rate
For
with
sure.
TD for a 3-year fix is 0.3% lower, and I'm trying to sell that First National 3-year, and the client's like, you know what, Matt, there's a 30% chance we sell in a year. I can map out and say, okay, if we sell in a year, what's the odds of a 3-month interest penalty with TD? Is the penalty going to be bigger that eats up that savings? And then I go and look at First National and I go and say, okay, they'd have to offer a 2-year fix at, let's say, 4.5% or 4.4% to trigger an IRD greater than 3 months interest. 1 month later, they'd have to offer a 1-year fix at that rate. And I go and look at that and say, that's harder to do. That's harder to do than TD Bank lowering their 2-year posted 1% because their 2-year posted is like so much higher.
The likelihood of that client selling and porting though is pretty high, right? Like if they're with a big bank, the porting features are better, to be quite honest, than monos.
Yeah.
You know what I mean? Like, what would you say to that argument?
Well, I mean, there's a couple things. One, you never want to be forced to port. You could have it where that First National mortgage, you're like, the math makes sense to pay 3 months interest and jump to something else because rates have come down, right? The best port is one you don't need. Like you think about it, like, yeah, if your rate's really low, you want to go and port it, right? And you also look at it as well as, are you thinking ahead? In that case there, if you're like, oh, you can port. Well, let's brainstorm what your port looks like. Will they allow us to buy first, job later? Like that's where the broker needs to be thinking the next step ahead, right? Because I look at it, if I go and say like, yeah, we'd like to port the First National mortgage you're dealing with, good chance of at least 3 months interest. Well, if we don't port it, I might be like, well, if I get a new mortgage for you, I'm going to give you back, here's some commission. Why? Because if I ported your TD and added 50,000, I only get paid this. If we can port First National, if it makes sense from a financial point of view, we'll do it. But if not, paying that 3 months interest and me pumping you a little bit is better because you're a free agent. You can go anywhere. Maybe now we get a new 3-year fix with TD and the rates are lower and the posted rates have come down. So I look at it, the more we rely on a feature, the more we have to make sure that it's going to work when we need it. Lenders that say portability, but it's a 30-day window, you have to close on the same day, you can't add new money. They have to be arm's length sales or purchases or whatever. They're just a pain. I feel like in some ways relying on porting and assumability almost minimizes the expectation that brokers should understand penalties. It's like, oh, if there's a big penalty, you just port. What if you can't port? What if there's issues? So I just find for this here, yes, it's definitely a factor to take into consideration, but you would need to be doing the future planning because you'd hate to have it where you tell them they can port, it's minimizing the risk, you're not explaining the risk. They go to port and you're like, oh, they don't lend in that province or that particular property, or they want 35% down. But I have another lender that will do it 20% down. We have to just dive deeper down the rabbit hole and map stuff out. It can't just be like, oh, you didn't tell us you were buying a mobile home in 2 years when you said you wanted to port. Like, we have to get this information to the client so that it's most likely going to fit and ask those questions. Or like a client retires, income changes, rates change, qualifying. It's just diving deeper and deeper. And the more we know what can happen with the penalties, at least we're protected if we have to go for that off ramp.
Yeah, I think right now it's an easier time to really poke holes in that and really just have them question the foolproof porting because, like you said, you have multiple different scenarios where you might not qualify with a port or you might not even want it. I think the biggest counter to that right now is the fact that if you're selling whatever mortgage and they're saying, oh, you know what, RBC, they've got this rate and I could port in the future. So I'm not really worried about penalties. Well, in that case, you can kind of say like rates in 2 years from now, they're going to be a lot lower than what they are today. And you're not
Yeah.
going to be able to be a free agent and look elsewhere for a lower rate. You're going to be stuck with that mortgage that you have right now. So why not be a free agent in that case?
But imagine you're RBC and someone wants to port a mortgage and you look at that mortgage and you say, you know what? We actually make more money if they return that mortgage. And maybe their porting team isn't as aggressive as their sales team. And they go and say, you know what? We don't care if we just don't get this done, and they blame us. They pay the penalty, they go somewhere else because they're paying a penalty basically us saying we can only get 2 or 3% when they're porting 4 or 5% or whatever. From our business point of view, getting that money back and having them paying an IRD based on whatever, or let's say they have a low rate of 2%, well, RBC wants them to return that, pay 3 months interest, and they'll lend it out at 4.5%, 5%. So the idea is that lenders are incentivized to put up roadblocks if getting that money back in whatever penalty is better than completing the term and moving to the new product. Because you think about it, it's extra work for them in terms of this. There's no new money. But if they want that money back, Why wouldn't they be steering the client towards that? Oh, we missed your email, pay this. I wouldn't be shocked if they told their teams to not respond as quickly for ports than for purchases or transfers. They could look at it and say, there's $10,000 of value to us if this 2% doesn't port, because we'll get it back, they'll pay a penalty, and we'll lend it at 4.5%. We'll even see with some of our lenders, right, where it takes longer to figure out the blended rate. The new money is at their worst rate. They just offer the porting, because if they didn't, then people would be like, well, I'm not going to sell and buy something, but now that you tell me I can't, well, maybe I want to. It's just looking at these things and just knowing how to minimize or knowing what your penalty is going to be is helpful, whether you have a penalty or not, whether you pay a penalty, whether you port the mortgage or not.
I think all of these things, the key points are they're just ways, obviously, to educate your clients so that you have more informed clients. You're doing a better job, better representation of the brokering industry as a whole in knowing this knowledge. But it's also ways that you can add sales, grow your book of business, and really create a better book of business by having well informed clients who understand this stuff and then are choosing you. So, we talked a lot about different reasons why brokers should know this knowledge and why they need to educate themselves. Let's talk a little bit about when you have that database of clients. I know we touched on recognizing those opportunities and going back, looking at rate sheets, stuff like that. But what are some other ways that you're going through your database and reaching out to those clients?
So I look at this, we should be telling them where their IRD is, whether it's negative 40,000. If it's negative 40,000, then we're more like, if you're going to do something, let's maintain this mortgage component, maybe line of credit in second position. If you're selling, let's port. If you're talking to other brokers, like, don't port your mortgage, well, the IRD is negative because the current market rates are higher than your mortgage. And so brokers here should be like, you should love and keep your 2% rate for the last 2 years, because why would you do anything and give that up and jump to today's rates and pay a penalty? So I find here what happens is as the IRD gets closer and closer here to 3 months interest, a window of opportunity, assuming the client's going to keep the product for the remaining term, opens up. But even if there's no opportunity, we still have to warn them, because that client might be like, they're going through a hard time. It looks like they're going to get divorced. They're going to talk to a realtor next week to list their place. Get an email from Brandon and Tom. Hey, I'm just letting you know your IRD is approaching 3 months interest. They had reached out to their bank. Their bank said your penalty is 3 months interest. They're going to list. And they're banking it on being that when it comes to the division of assets. So just mapping this out and having it where the client sees that letting you know what they want to do helps them and that they're getting the service from you. And then obviously as the windows close, or like, hey, your penalty's not 3 months interest now, it's 4 months interest, it's 6 months interest, it's 12 months interest. You're going to alert them before they even think about it or before they even hear from the lender. Even though the lenders could have a portal that shows what it is, here's what has to happen. When it happens, have a button you click to go into an open. And here's the cost after a month, and here's the break even point. They can do that, but they don't, because clients end up paying more the less they understand the rules.
Any plans to build out software that automates this for mortgage brokers?
Not unless they're doing the training. And like we talk to people in tech and stuff like that, it's very difficult because like you look at, like, I've been running training for over a year. People see my calculator, they ask for it, and I haven't given it to anyone except our development team that's going to digitize it and put it, behind a paywall and people can use it. But they're only using it if they're attending a training session with me where we go through and say, look, like it says at 53 months, we go from this to that, and it goes up. But I don't know on which day we go from 54 to 53 months. I know we have 55 months remaining right now. I know we have at least a month before we get to 53. You need to go and reach out to TD Bank or whoever and say, on which day do we go from 54 to 53? Because I'm not chancing where I calculated it wrong and there was a leap year and it's a day early or a day late or whatever. They have different references for this, and you make sure that they're aware. And you don't cut it close. You're better off leaving a week early. Are you familiar with the term a baker's dozen? Have you heard where that's originated from?
Not originated from, no.
I don't know where it originates from. I just know that I always get them at the
Okay.
bakery.
So go back in like medieval times, a baker selling loaves of bread. If they measured the bread and it was like an inch too small or whatever, like they got major fines. If I put them in the town courtyard and threw tomatoes and stuff at them. So what they realized was it was safer for them to throw in an extra loaf. So someone's measuring, like, here's the extra 2, 3, 4 inches or whatever that's missing. And so when I look at some of these calculations, I believe that there's situations where lenders charge a little bit less. Why? Because the last thing they want is a class action lawsuit where someone goes and says, oh, this bank's been overcharging by $2 on all these payout statements. They'd be better off being like, oh, we actually undercharged by 30 or $50, right? Because at the end of the day, that's better business. So when I do the calculations, I don't know if there's something kind of built in there that might give someone $50, $100, $200 less than how I interpret the definition, but might be a fail safe for the lender because they ever get challenged like, oh, funny story, we didn't overcharge. In fact, we typically undercharge from anywhere between $50 and $200. And then whatever class action lawsuit is dead on arrival because they go and say, yeah, oh, we said there's 30 months remaining. We're actually charging the interest rate differential for 29 months. And I wouldn't be surprised if they did that. So that's where if I go and estimate, I'm estimating a little bit high. But a client, if I tell them their penalty's going to 10 grand next week, they're not going to be upset if it's 9,800 or 10,200. We're going to figure out what the triggering event is, 53 months remaining, this posted rate being lower, around here, here's what we're dealing with, and then we're going to pinpoint what it is with information for the lender.
Yeah, it's obviously hard to pinpoint everything accurately with so many variables, no pun intended, with everything you got going on.
I say factors instead of variables because I don't want someone like, are we talking about fixed or are we talking about variable?
Yeah, exactly.
Factors.
Yeah, I had to catch myself too. That's just where my head goes as a business owner. I always look for opportunities. I think if you can build something out there, that would be amazing. But anyways, we don't want to keep more of your time, Matt. It's been an absolute pleasure. I think you dropped a lot of knowledge for brokers here and definitely something for brokers to educate themselves on. So with that being said, if they want to get started and first of all, educate themselves on penalties and second of all, look for opportunities if they do have past database, how do they get started in your program?
So in this case here, so we have our Prepayment Penalty Mentor program. Like it might change by the time this is posted, but currently right now, the program costs $399 and that gets you access to the end of the year. We're going to have a promo code. We're not sure if we're going to switch to a monthly subscription once we launch the calculator. The thing here is you don't get access to the calculator unless you have the training. And we really want to create like a certification program. It protects you, it protects us, it protects the client. Like at the end of the day here, we don't need it to be exact. And that's why for here, I think with the tech, it's taken a while because everyone's focused on it being exact and less focused on, well, what can we actually do with that information that we have, right? And how does it change and like be right big and wrong small? So we'll have the links that they can go and sign up. Like I said, we might switch to a monthly subscription. We'll do something for the commission breath, your followers, your viewers. Challenge your lenders. You should have it where every single document that can be put in front of the client that you get a copy of it redacted before you even send them business. If they won't show you a payout statement of what it looks like before you send them business, you're going into that relationship with not all the information. And if you think of it, if we connect a client with a lender they've never heard of, even if that lender messes up, who do they blame? They blame us, right? Our clients are not guinea pigs. If a lender's focusing on a low rate, what's the catch? There's no free lunch. So at the end of the day, they might have it where they charge more on penalties. So like lenders that have less comparison terms or they compare it to bond yields or a reinvestment rate tied to bond yields or posted rates that they can manipulate willy-nilly, those are lenders that can offer a lower rate or more commission to the broker. But who's taking on the risk? Those who return the mortgage early, subsidize the interest rates for those who don't. So it's about identifying the products, asking the questions, paying attention, the posted rates, the discounts. Like you think like for the banks, what's the lowest rate we're getting right now? 5-year fix. But if you look at a rate sheet, why are the 4-year posted rates lower than the 5-year? That doesn't make sense, right? So you look at these things, if we're dealing with monoline lenders, it tends to be the shorter term are a higher rate. So if you have where they're comparing to an actual rate and you're getting to those shorter terms faster, that's a bonus. More likely to have an IRD that's 0 or less than 0. So just mapping this stuff out. I do training stuff here or there. People can reach out. Like I'll try to point people in the right direction. You can do this on your own. It just takes more work. You can do the calculations, the quick calculation. You can do it on your own. I believe you get there faster to be a prepayment penalty expert having a mentor. So that's where for here, engaging, reaching out. This protects you, protects your clients. If you're a brokerage, we can present to your brokerage. Today I presented to Rock Capital, Vine Group, and Origin. So I've been talking penalties all day, but it just comes out of having the conversations, talking about this stuff, monitoring the IRD before it goes up beyond 3 months interest, and engaging with the clients, knowing which lenders have an open term and which ones don't. A lot of our monoline lenders, it's hard to get an open term at maturity. They don't have a midterm open. So one of the things I've been recommending to the monoline lenders is have a midterm open. Because if my IRD is getting here, shouldn't I have the option of paying the penalty and going into an open and then selling 2 weeks, a month later? Give the consumer the option, give brokers products to go and sell, cheer rates going lower, but don't forget your existing clients with fixed rate mortgages. The lower rates go, IRDs can only go up.
Awesome. Well, thanks, Matt, for sharing all this knowledge today. For listeners, check out the Prepayment Penalty Mentor. Matt will guide you through all this because I know it's a lot to take in, and he'll show you these opportunities, teach you all this stuff. So definitely check that out. And thanks again, Matt, for joining us.
Hey, thanks, Brandon. Thanks, Tom.
Thanks, Matt.
Cheers.